Good afternoon everyone. This is Abid Khan and you are watching Karachians Academy YouTube channel. So we are doing A-level accounting paper 9706. So we have selected May-June attempt of this year 2022. This is the latest one. So paper is 9706 and 32, right? Today we will be doing question number in connection with our previous videos on the same paper. So today we will be solving question number 6. So let's move on to question number 6. So this is your question number 6. The directors of M Limited plan to buy a machine for a new product at a cost of rupees 160,000. Student, always remember to keep highlighting the key points, right? It has a useful life of 4 years, no residual value. Okay, fine. The number of the units produced and sold are expected to be as follows. They have given you this number, 25,400 are the total in 4 years. The unit selling price is $28. Okay, this is selling price, and variable cost is $10 per unit. Fine. Then okay, annual fixed costs including depreciation. The annual fixed cost is of 90,000 and it has the depreciation in it. So we will exclude depreciation up to the level of 6,500. They are saying till the unit 6,500. If you are producing units up to the level of 6,500, so your fixed cost will be 90,000. When you will cross the benchmark of 6,500 mark level, then your fixed cost will increase. How much this will increase? The fixed cost will increase by 10,000. 10,000 for each. 10,000 for each. 10,000 each time the production level increases up to 1,500. So till 1,500, if it is 1,000 increase, this will be, if it is 1,000 increase, 10,000 will be increased. Okay, if it is 100 or 200 or 300 or 1,400 till, this will be, there will be an increase of 10,000. 1,500 you will be increasing 10,000. But if you are producing incrementally 1,600 or 2,000 units, then on the initial 1,500, 10,000 will be added, right? And if it is 1,600, then on 100 additional 10,000 will be added. So this is the logic. You have to understand this one. Okay, then what is required? The calculate the cash flows. Okay, so calculate cash flow. We can calculate cash flow, no issue. So what I am doing here, we will solve this question here. Question we are solving A. The units we are producing 7,000, 7,500 and 4,200. Incremental units you are producing over 6,500. Over 6,500, how much units you are producing? So here 0, here 7,500 minus 6,500, 1,000 unit over 6,500, 8,500 minus 6,500, 2,000 over unit over 6,500 incremental. Here no. So in year 2 and 3 you are producing more than 6,500. So how much would that be? So incremental, these are the incremental unit. We will calculate how much will be the fixed cost. The fixed cost will be here 90,000 is the fixed cost minus, okay, so you have to deduct depreciation. So we can calculate depreciation here. We can say this is our working number 1. So depreciation per annum is equal to 160,000 depreciable cost over to 4,000. 40,000 is your depreciation. So you will deduct this 40,000 from here. So net would be 50,000. In year one, your fixed cost will be on 5,000 units, 50,000 cost. Come to 7,500. Till 6,500 there will be 90. Okay, but you have increased 1,000 in incremental unit. For that you have to add 10, because as I explained you, and then minus 40,000 depreciation. So this will be 60,000. So come here. So 90,000 will be your fixed cost, plus for initial 500 increase unit 10, and then for 500, because you are producing here incremental unit 2,000 more. So for 1,500 10,000, and for remaining 500 another 10,000, then minus depreciation, which is 40. So this will be 110 and then 70,000. Here no debt, only 90,000 and minus 40,000. So this will be 50,000, right? So our cost will be 50,000 and 60,000, 70,000 and 50,000. This is the fixed cost. They have given you sales price, so we can work out sales at $20. So 5,000, let me open up my calculator. So 5,000 are units, sales price is 28, so this is 140,000. And then 7,500 are your units, multiply by 28 selling price, this will be 210,000. Then 8,500 are unit, multiply by 85, so 7, I think something went wrong. 8,500 units multiply by 28, this is 238,000 sales. And then 4,200 are your unit, and selling price are 28, then 117,600. okay, then we can calculate variable cost. We can calculate at $10. So 5,000 and this will become 50,000. 7,500 unit means 75,000. 8,500 unit means 85,000. 4,200 units means 42,000. Then fixed cost we already have. We have calculated fixed cost here. So our net cash flow will be sales minus variable cost minus fixed cost. So we can work out 140 is sales, minus variable cost is 50, and minus 50. So this will be 40,000, right? And then 210 minus 210 minus 75 minus 60 of fixed cost. So this is 75,000. Now your sales price are selling sales 238 minus 85,000 is variable cost, then fixed cost is 70. 83,000. So net cash flow will be 83,000. Here 117,600. This is your selling price minus 42,000. 117,600 total sales. 42,000 your variable cost, and 50,000 selling price. So this is 25,600. So we are done with a part A of our question, which says to calculate the net cash flow for each year. Okay, so we have calculated this. What it requires for other questions, other part. This is other part, right? We have done with this. What it says, the cost of capital is 10%. Relevant discount factors are the cost of capital. Actually, the cost of capital is 10%. On 10%, they have given you the present value factor, PVF, or we can say DF, discount factor, PVF or DF. At 16%, they have given you discount PV factor or discount factor. Calculate the proposed purchase, the net present value, NPV and IRR. We have to calculate NPV and IRR. So in A, we already have calculated net cash flows. 160 is your outflow, and 40,000 is our cash flow. We have worked in A. So now we are doing question number B. So this is B, right? So 40,000. Then you have to calculate. These are your cash flows. So you have to calculate it, NPV. So NPV on both the rates, 10% and 16%. But actually your NPV, so because your cost of capital is this one, 10%. So you have to calculate NPV on 10%. But if you want to calculate IRR and the next, so then you have to calculate 16% NPV also, because when you increases the rate, the discount rate, your NPV becomes negative, right? So then we will calculate present value. We will calculate present value. Present value at 10%. So we can calculate present value at 10%. This is 0.9 multiplied by 40,000. 0.909 multiplied by 40,000 is your cash flow. So this will be 39,600, right? Just 1 minute. $40,000. 0.909 multiplied by your cash flow is 40,000. 39,600. 39,000. Just 1 minute. Factor is 40,000 is your cash flow. Let me check how much was our cash flow. 40, 75 and 83 and 26, 500. This was your cash flow. Okay, no problem. $40,000 and 75,000 and 40,000, 75,000, 83 and 26. So okay, 10% on 10%, your factor is 0.909 and multiply this by cash flow is 40,000. This is 36,000. $360. Then 0.826 multiply by 75,000 is cash flow, net cash flow. This will be 61,950. Then 0.751 multiply by 83,000. This will be 62,333.683, this, and multiply by 25,600. This will be 17,485. So if we do calculate of this all positive values, how much this will be? 36,360 plus 61,950 plus 62,333 plus 17,485. So inflows, the present value of inflows is 178,128, right? And our outflow is 160,000. So you are getting more positive value. Inflows are higher than the present value of your inflows are higher than your outflows, right? So this is positive NPV. 178,000 minus 160,000. This will be 18,128. So your net present value will be, so you have calculated this part. Now he is asking you for internal rate of return. So internal rate of return, I am referring to the course book of CIE David Hopkins. So their IRR is calculated, or you can refer to the other books as well suggested by the CIE. So the formula of the internal rate of return which is provided to us is, so we have done with this. IRR is equal to capital P plus N minus capital P difference multiplied by small p divided by small p plus small n, this factor, right? And what is capital P and what are these? So I will, this is very simple as given into that book. So basically what are they? So we will calculate this, but 16, I'll explain you this one. Move on to calculate present value at 16% as well, because you, for an IRR you need this calculation. So on present value if you want to calculate, then 0.862 multiply by how much is cash flow? Cash flow is 40,000. So this will be the factor and this will be the cash flow, 40,000. 34,480. This will be 34,480, right? Okay. So then this factor 0.743 multiplied by 75,000. This will be 55 and 725 and 160,000 is negative in year 0, negative. These are the positive. Then 0.681, 0.641 multiply by 83,000. This is 53,203, and then 0.552 multiply by 25,600. This will be 14,131. Okay, so we will do calculation and we will do total of this. How much is this? We will do calculation. 34,480 plus 55,7. Okay, 34,480 plus 55,725 plus 53,203 plus 14,131. So its total will be 157,539. Okay, so now you the present value of net cash inflows is lesser than the outflows. It means your NPV will be negative. So means this at 16%, this is not viable. So this will be 2461. So we have calculated this. Now we have to calculate IRR. So I shown you this formula, and whenever the capital is there, what capital shows? Capital means it shows rates, and small letters means values or absolute amount on these rates. So capital in capital P and capital N. So this is means this is your capital P. Capital P means positive, capital N means negative. Capital P means positive rates and capital N means negative rates. So capital P means the rate on which your net present value is positive, right? And capital N means the rate of discount rate on which your net present value becomes negative. So on 16%, your value is becoming negative. So negative N means 16%. The rate at which net present value is negative, and 10% capital P means the rate discount rate at which your NPV is positive. So capital P and capital N. The value on capital P means the positive. On capital P, the value positive you are getting is called small p, means positive value, and this is called small n, means negative value. So we will be putting these figures here, and we will get IRR. Capital P is 10%. This is 10% plus the difference of P 10% plus the difference n minus p is 16% minus 10%, the rate difference, n minus p, this is n minus p, and this will be multiplied by p upon p means the positive value, 18,128 divided by 18,128 plus 2461, right? So how this will be 10% plus difference of 16 and 10 6%, this will be multiplied by 18,128 divided by 18,128 plus 2461. So this will be 20,589. Now we will see 10%, right, plus 6% multiplied by the factor 18,128 divided by 20,589. So this is 0.88. it was 0.88, and if you multiply this by 6%, this will be 5.28. 10% plus 5.28%, right? So this will be 15.28%. So your IRR will be 15.28%. So we have done with C. So we are done with B, all parts. Guys, thank you very much. This is all for today. So hope this will clear all your doubts and misconception, and you will be able to do this question very easily. So that's all for today. Thank you very much, and bye for now.